Well, hello and welcome, everyone. My name is Elio and thank you for tuning in across this wonderful region of ours and for coming to learn a little bit about reporting season in Stockopedia. I mentioned my name's Elio. That is Chris Batchelor. G'day, Chris. How you doing?
G'day, everybody. I'm doing very well. Good afternoon to all our listeners, and good morning to those of you in the West.
Yes, very true. Of course, it's always funny around this summertime. But together, Chris and I are Stockopedia Australia and New Zealand. So thank you very much for investing your time in this session today. We sincerely hope you find it of deep value, not just with regards to the insights from reporting season, but also a bit of a look into Stockopedia and how it helps the 15,000 and more global investors every day navigate such choppy times like now, the reporting season. So thank you very much for tuning in, one and all. Now, I'll this session today is going to be run with Chris and I in tandem, to which I will take you through the initial introduction, and then Chris will also start or kickstart the stock talk with regards to the reporting season and the like, and also stocks to watch. So he'll join us in a minute. I'll take you through this first formal part of today's presentation, which, just as a reminder, just as a reminder of the agenda for today, we're going to basically give you a bit of an introduction in regards to Stockopedia, the power of factor analysis and how it helps us navigate such times like this. We've also got stocks from the reporting season, a demo of the program, and then the Q&A, your stock questions asked. Your opinion, you may very well want an opinion on the stock that's reported a week or 2 days ago. It doesn't matter, but just ask us and we'll be more than happy to cover it as part of this presentation. It is also, I must remind you all that the information in this webinar today is of a general nature only. None of it is intended to be taken as financial advice in any shape or form. It is purely for the purposes of education. Now, for those of you that may remember, shares don't just go down, they also go up, which is a nice thing to remind oneself when we're in environments like this. But of course, past performance is no indicator of future performance, notwithstanding the solid performance that one has been able to achieve over that time. And if you wish to speak to anyone else other than your significant other in life about any of this content today, then you need to do so with an advisor that's licensed to have that conversation with you. Unfortunately, we cannot. Yes, and we will be recording this presentation today for everyone, so no need to write that in the little chat box, which a number of you, I'm sure, will be thinking about doing, but it's okay, everyone. We will make sure that everyone gets a copy post this presentation. So what community is this? Stockopedia is a UK-based company. We are a global provider of quantitative insights. We do so for over 15,000 clients around the world. The vast majority of our client base is in the UK, but we've now set up here in Australia as well. I say that because the chap in the bottom left corner there, Ed Croft, he made his way to the colony, as it were, and decided to give us a kick along with regards to the launch of the product here in Australia and New Zealand. And there's Chris and I just off to his shoulder. The business was founded by Ed back in Oxford quite a few years ago, I think 16 years ago now. And he was motivated to learn what factors actually drove stocks. He, like many, lost a lot of money during the GFC, and rather than just getting mad and throwing the bat and ball and taking it and going home, he decided to actually go and do some deep research into understanding what drivers there are for the market. And the fruit of that labour has been presented in Stockopedia, which we're going to talk about today. So Chris and I, just very briefly, we run the Australian and New Zealand business. We look after the sales, the marketing, and also staffing levels. So effectively, we run the service in Ed's stead. We provide support within the system. So if you've got a question that is, Australian and New Zealand focused, rest assured that the people that are answering your question are knowledgeable in regards to the Australian market. We provide editorial content, so Chris and I regularly write and contribute editorial content. And that can span pieces that are education-based, factor-based, stock-specific based. So there's a range of content. Plus, we get contributions from our global team, which get added as well. A nice little one that I read there from yesterday, including the type of scan that Warren Buffett would run. Quite an interesting read. So there's a wide range of content that's available for investors to really build their education and help them make confident and informed share market decisions. Daylight Financial Group is the group that provides the financial services license from which Stockopedia is able to operate here in Australia. So we are governed by the laws of the land that ensure that we are acting in a conscionable manner and doing so according to the letter of the law, which is very pleasing for us, of course. Okay, so it's time to talk about the power of factor analysis. Some of you may be very well thinking, what the hell is factor analysis? Well, I'm about to tell you, so you're in for a treat. Look, very quickly, I'm not going to bore you to snores with all the academic detail, but I think it's important that you understand some of the history to how we got here today and the reason why Stockopedia is so powerful. So I'll start with Farmer and French, I suppose the godfathers of factor analysis. Actually, one won a Nobel Prize, the other didn't. Geez, that'd be an interesting dinner conversation. But anyway, basically, they discovered through academic studies and various other rigors and the like that there were actual factors that could lead to outperformance of the market. So the previous thinking, known as the capital asset pricing model, I'll keep it simple. The idea was, look, folks, you just can't outperform the market. Okay, yeah, sure, you'll have periods of outperformance, but that's driven by volatility. That's got nothing to do with the actual stock itself. You will simply just replicate what the market does over long term. So all this academic work had gone into this concept and idea that really shares just deliver share market returns. But Farmer and French threw this on their head when they did deep analysis and were able to find that no, there were common traits or factors whereby things could be applied which could explain variances in market performance. So they looked at things like size, for example, PE. There were a range of different items. They ended up coming up with what they called the three-factor model. Of course, they were lauded for this research because it, I suppose, decimated a previous thinking that had been very strong, that which I actually learnt at university as well before Farmer and French came along. And this has spurned an entire industry whereby factor analysis and factor investing has really become a big norm. So we're talking multi-billion dollars invested across the board using this style. Now, the thing to note, though, is Farmer and French didn't discover this. I mean, the idea of factor investing or investing a particular way to drive out performance has been a belief and thought that has been run by many people. Of course, we all know Benjamin Graham, the father of value investing, as he's often referred to, very much a deep value style of investor. And he, of course, educated Warren Buffett, whom added elements of quality, return on capital employed, and a whole range of other things whereby, look, it's great you're picking up cheap stocks, but they've also got to exemplify quality elements as well. So, and then we also had Dryhouse, Mr. Richard Dryhouse, who managed a very large amount of money in the US using momentum-based factors. And even before him, you had your people like Gann, of course, you've had Wyckoff, you've had Weinstein, you've had a whole number of others that used momentum or charting, as it were, in order to help give them an edge with regards to identifying factors that could lead to broader outperformance of the market. So, and of course, there were many more before them. I mean, it goes way, way back. These were the first that actually, I suppose, how shall I put it, articulated it in a means of being able to replicate and apply over the world of investing. But of course, everyone's been looking for that, the golden egg, as it were, that can lead to consistent outperformance, which is what we try to do. Now, we don't necessarily try to drive 100% outperformance, and nor are we trying to pick the right stock 100% of the time. But what we do is we actually identify the key factors that are driving the stocks at the moment. So we measure these drivers. So we look for stocks that exemplify quality, we look for stocks that exemplify value, and we look for stocks that exemplify momentum. We then rank each of these stocks basically from 0 to 100. And ultimately, that allows us to see which companies on the market at the moment are those that exemplify the best quality metrics, those that exemplify the best value metrics, and those that exemplify the best momentum metrics. So this is a big piece of work that our software and development that we've had in the background is able to do. And it is particularly useful at this time of year, which is reporting season. Now, to just also further add color to that, well, that's good with each factor working in isolation. But what about a blend of the three, bringing together these powerful factors whereby you could find good, cheap, and strong stocks and actually go about investing in them via a method that we call the stock rank. So we actually take each of the rankings from each of the three factors. We then combine them all together in a collated score, and then everyone is ranked against everyone else in the stock exchange in order to come up with a relative measure. Again, between 1 and 100 being the strongest. And investors can easily see, well, across the three factors that drive market returns, that all the academic studies have shown us in the past that are actually evident and do drive performance. Well, then why don't we combine the three and what we've called the QVM, so which is quality, value, momentum, of course, otherwise known as the stock rank. And you'll see the stock rank everywhere in Stockopedia. So it's one of the things that we highlight quite frequently. You'll see this a lot in the demo. So you'll see my mouse has gone towards the top there just to highlight that. So you'll see this everywhere, and we'll point to it on all the stocks that we cover in today's session, be it either in demonstration mode or when we're responding to your questions. Okay, now, why is this necessarily important? Because one of the things about identifying stocks that are, that exhibit the qualities of being, good quality business, representing reasonable value, and at least have momentum, or the market acknowledges the fact that they have that, is that not only does it deliver solid performance, but it also tends to be a more consistent and smooth ride. It helps you erode some of the volatility. Now, in Australia, we're quite unique. We're very different than the rest of the world. I can tell you, it was quite an eye-opening experience for Ed when he was down here having a look at our systems and how everything worked, but I was glad to enlighten the boy. But nonetheless, in regards to this chart here, this ranks goes back to 2016 when we started the stock rank process. What you're looking at here is just an entire list of companies, the ones that are ranked between 80 and 100, or no, 90 and 100, sorry, and then those that are ranked between 0 and 10, and that's the red line. And then you got the broader market as well, which is the blue line. Now, I don't want to get too bogged down in the detail here in regards to this, because past performance is no indicator of future performance. This is not a replicable portfolio because it basically encapsulates everyone that ranks a 90, for example, and sometimes there's a liquid stocks. Sometimes you might have a different price getting in and out and a few other things. So I just want to emphasize it's not replicable, but that really doesn't matter, because what it exemplifies as an entire example is that if you're finding good, cheap, strong stocks, then what you're going to be doing is you're going to be looking for a broader strategy which can deliver for you not only the chance to outperform, which fortunately they have, but also a more smoother ride, as opposed to the 0 and 10s where, these story stocks can go bananas. And actually, they did have a period of exceptional performance, but you can see that they've reverted back to the fundamentals and now underperformed the broader market. And if you're an investor using that type of strategy, well, then I sincerely hope you got yourself a parachute, because often you can fall quite heavily from dizzying heights, which are very difficult to actually recover from. So I shouldn't make light of that point. That's actually quite serious. So what we want to do as investors is we want to employ strategies, and we have measures in order to help us identify or look for a group of stocks from which we can commence our research from. And if you focus on companies that exemplify good qualities, then what that does is it helps block out that noise, that noisy nonsense that can confuse us with regards to the market. You can just simply jump in there and fish where the fish are, as it were. Look at the stock ranks, look for those quality, good companies, and focus on them as your primary source of research. And then once you've got them, monitor them. So then you can see how they evolve, how they change. Are they going up? Are they going down? Because often the trajectory of where those ratios go or those factors go is just as telling as the absolute number itself. And we'll talk a bit about that during our reporting season discussion. So how do we do it? Well, we measure, like I said, quality, which includes well-known ratios such as return on capital invested, profit margins for the company, the cash flow of the business, which is very important, of course. As they say, revenue is vanity, profits are sanity, but cash is king. So cash is very much a key factor that we analyze when it comes to assessing quality. Financial health of a business, that's the Q rank, of course. Value, we look at things like price to sales, price to equity, EV to EBITDA, so that's enterprise value to earnings before interest, tax, depreciation, amortization. Aren't you glad you came, folks, to get all these wonderful acronyms shared with you all? The dividends of the stock. So these are factors that drive value and the value discussion. And then you've got momentum, where you're looking at things like relative strength. How strong have they done compared to everyone else? How close are they to their 52-week high? Have there been earnings upgrades? And this is important because momentum is not just about looking at price. Momentum is a mixture of price momentum and also analyst momentum and earnings momentum. So as earnings go up, as analysts revise earnings up, all those get captured within our momentum indicator that we display and show everyone in the system. We can then blend these factors. So we've got each of these individual factors, but then you might decide, no, you know what, I'm going to blend quality and value together. Or you may decide I'm going to blend quality and momentum together, which is what I do. Then you get someone like Ed, who likes to combine value and momentum together. That's the thing about Stockopedia. Stockopedia is not a dogmatic approach. There are many faiths in this church we call investing. Our job at Stockopedia is to actually present to you reliable numbers that you can assess in order to help you make a decision around the types of stocks that you want to be holding. Myself, I want to hold quality and momentum stocks, but you might be different. And it's not for me to judge. In fact, I would argue that the key to our performance is not necessarily the strategy you pick. Rather, it's changing that strategy in midstream, where most of us get slaughtered. So if there's a particular way that you like to go about investing, then definitely Stockopedia is able to assist you. And then, of course, there's that broader stock rank, the QVM score, whereby we combine the quality, value, and momentum factors together to give you an overarching score. Again, this will be something that we demonstrate through our examples that we'll be covering as part of this. But hopefully this gives you a little bit of a background in regards to the way that we look at the research world, because, of course, there's many opinions in the market. I can pick up the paper today and I see 300. Okay, so 300 times 5 means I've got 1,500 stocks to invest in on a weekly basis. Not pragmatic. So if there is a stock that piques your interest, go into Stockopedia, assess the numbers for yourself, and make an informed decision as to whether the stock aligns with the type of investing approach that you wish to employ. Because if it doesn't, you don't need the stress of dealing with a stock that becomes just too hard to manage. Whereas if you're holding stocks that align with your strategy, then it becomes easy to get rid of them when you need to. That when to sell question everyone asks about. Well, it's easier to sell if you know why you're bought in the first place. And when you buy just from a tip from a newspaper, or even worse, a taxi driver, it makes it particularly difficult. So hopefully that explains that information a little bit more. All these are within Stockopedia. They're available. There's a lot more there. There's a screener tool we have that we can screen for all these factors, and you can have them. And these factors are getting updated daily. The quality ones definitely are more impacted around the earnings season, because that's when we get the latest set of financials that come through from the company's accounts. Momentum on the other scale is the more frequent one because, of course, price shifts all the time, and therefore that can very well change. But you can run regular scans on this on a daily, weekly, or monthly basis if you wish, in order to keep abreast of what stocks are ranking high within each particular factor, and therefore that can help govern your investment decision process. Now, there is another thing we do. So it's not just enough to rank the overall rankings. We also give stocks a stock rank classification. And we've broken them into two core approaches, with the middle one being neutral. That's obvious enough. But if you look at the winning profiles, you've got things like the super stock. Now, that's a stock that rates highly on all the three factors of quality, value, and momentum. You get a high flyer, for example. that rates highly on quality and momentum, but doesn't rate all that highly on value. Often a number of the stocks I invest in will be high flyers as well. You get the contrarian, whereby they're high quality, high value, but very poor momentum. And then you have, of course, the turnaround, whereby they might be exceptional value. They could be good momentum, but their quality is just not there yet. They're a turnaround situation. And then you've got the losing profiles. Bless them. Very similar. I mean, we've got the falling stars. The sucker stocks are the ones where all the three are wrong. I'm not going to, again, go into too much detail. We will have a little bit of a discussion on that when we do go into stock demonstrations. But ultimately, through the stock rank system and the various factor research that we do, plus this stock categorization, you can quickly and immediately see that where your current stock sits. Knowledge is power. This empowerment comes literally within 10 seconds, rather than having to go through and read copious amounts of annual reports and documentation. And that's what we pride ourselves as Stockopedia. It's why we are the essential tool in the kit bag of every serious DIY investor. Okay, so now I will welcome back young Chris, wherever he's gone right now. There he is. He's jumping back on now, because this is the part that he will take you through with regards to the earnings season and what we've seen to date. So, Chris, over to you. And yeah, Chris, unfortunately, your little monitor or your screen hasn't appeared. So if you want to just shut that down and reopen it again, hopefully that should work.
Okay. I'll just try turning on my camera and turning it back on again.
Otherwise, I can do a pantomime to entertain everyone. I've done a lot more for less. So by all means, take it away, Chris. It's over to you.
Yeah. Okay. So, we're now, 22nd of February. So we're, 2/3 of the way through reporting season. And of course, this is probably the busiest week of reporting season. And so we're starting to get a pretty clear picture of how things are unfolding. So, some of the information that's been coming through, the broker Barrenjoey commented in the AFR the other day that of the 91 companies that had reported so far, about 40% had beaten their earnings per share expectations, and that compared with 31% that had missed their EPS expectations. Then when looking at earnings per share outlooks, Barrenjoey had 16% that they considered to be upgrades versus 21% in downgrades. So overall, that's a fairly balanced reporting season so far, but perhaps the outlook is tending a little bit to the negative, but it's not hugely negative. But of course, within that, you've got a series of winners and also some losers. So what we've done is we've done our own analysis as well. And you can see on the screen there that, we looked at all the companies with a market cap that's greater than 500 million. And of those, 28 of them had increased their stock rank by 5 or more. And you can see some of the standout ones there, Sentai, Endeavour, Magellan, Lend-Lease, Cochlear, Wesfarmers, ResMed. Some of those, may surprise a little, and I'll just dig into Magellan in a minute. But, that's quite a good selection. So if we can go to the next slide, Elio. So on this one, you can see that there were also 24 companies, so a pretty close number, that have decreased their stock rank by 5 or more. And again, some examples, Verizon, Commonwealth Bank dropped 21 points, AGL, Insurance Australia Group, Codan, Telstra. Now, of that list, what's interesting, I thought, was that 4 of those companies are very widely held by retail investors, being Commonwealth Bank and Telstra, which were privatised back in the 90s. And, of course, Insurance Australia, which was the old NRMA, and AMP, which demutualised and, again, gave shares to their policyholders. So a lot of retail investors who otherwise may not have entered the share market actually do hold those shares. I'll also just dig into Codan in a minute and have a look at some of the factors driving that particular company. So this particular chart is just a sample. I just grabbed a sample of different stocks that have reported. And what I thought was interesting here is to just break out the actual result, then the outlook, and then the market's reaction. And there are three sort of different components to how to what we learned during reporting season. Often the result is anticipated, but not always, and so the market will react if that result is a surprise. And you can see there, a bunch of positive and negative, and a couple that were fairly flat. Flat means, basically was what people were expecting, or it was very similar to the last period. And then the outlook, and again, you've got a mixture there of positive and negative. Now, what I thought was quite interesting, the stocks with a positive result, positive outlook, and the positive market reaction, well, they increase their ranks, and you more or less expect that to happen. And as a general rule, stocks that declined in rank had negative or flat results. But one exception to that is CDA, Codan, which we'll look at in a minute. What's quite interesting is where you get the situation where the rank has increased despite the fact that there's been a negative market reaction. So an example of that in this list is Nick Scali. Another example not on the list is Adairs. These are stocks that are potentially worth having a look at and just investigating to see if maybe there's an opportunity there. Maybe the market's overreacted based on some short-term issue, whereas the overriding quality of the business may still be quite positive. And then, of course, there's Super Retail Group, SUL, where they have a pretty good result, but their rank hasn't changed, and that's for the fairly obvious reason that there's not a lot of room to move once you're at 98 already. So moving on to the next slide. So an analysis that we've done is to also look at not just the stock rank, the overall stock rank, but also to dig down into those components that Elio's been going through in the earlier part of the presentation. And it's important to understand what is driving the changes to the stock rank. Is it the quality? Is it the value? Is it the momentum? And these will influence how you choose to invest. If you're a person who's really focused on value investing, for example, then despite the fact that Breville Group's overall rank has gone up, you're probably not going to be interested because their value has declined considerably. And likewise, so if you're a momentum-oriented investor, then there's stocks there that would interest you that might not interest a value investor, for example, ASX or Beach Energy. Now, this is just a snapshot of a table that was published in full on the app this morning. So if you've got a free trial, you can log in and look under the Market Insights blog, and you'll see a table covering the whole, every stock that's reported to date in there. So have a look at that. And if you're not doing a free trial, I'd suggest that you jump on one so you can have a look yourself. All right, so we'll move on to the next slide. And I'm just going to spend a few minutes now delving into a couple of these stocks. And I'll start with Magellan Financial Group. Now, Magellan's been in the news a lot, and indeed it was the first stock that I wrote an article about at the start of this year. And in that article, I said that the key thing is that they've got to re-establish trust. It's going to be a long process, but there's some suggestions here that has started to begin. The January funds under management figure increased for the first time in a long time. It was only by a small amount, but nevertheless, it was finally not going backwards. That said, they did still experience outflows, but they were relatively small, and the positive performance outweighed those. Of course, it's only 1 month, so a lot more evidence is going to be required before we can confidently say that that's a sustained recovery. But what I found interesting with Magellan, after they'd reported and I analysed, the result, is looking at the pre and the post reporting stock reports in Stockopedia. You can see that the stock rank has gone from 75 up to 90, and then as I've highlighted there, it's actually the momentum that has driven most of that, which has gone from 9 all the way through to 51. Now, there's a bunch of factors that influence momentum, and I'm not going to delve into all of them right now, but I've highlighted a couple in this slide. And you can see there that the 6-month relative strength indicator still negative, but it's a lot less negative than what it was previously. And then the price versus the 50-day moving average, that's now shifted to positive, whereas previously it was negative. So they're just two of the positive indicators there. And then down the bottom, you've got that analyst consensus chart. And what that shows you, the sort of faint arrow is the previous recommendation, and the darker one is the current recommendation. And so you can see that that's slid towards the right, which means that whilst it's certainly not being recommended as a buy, there's less emphasis on a sell. So the overall, the average recommendation is shifting back into positive or towards positive territory. It's not there yet. Okay, so let's move on to the next one, and that's Codan. And I've highlighted Codan because it moved in the opposite direction. If you look at the pre-stock rank, it was 77, and then the post-reporting stock rank is 67. And again, I've highlighted the two, in this case, two main drivers of that change, which is the value and the momentum. Can we go back to Codan?
Whoops, Daisy. Sorry about that.
Thank you. Okay, and so I've again down in the bottom right corner there, I've emphasised the momentum, or one component of the momentum change, which is the analyst consensus rank. And in this case, you can see that the darker arrow is to the left of the lighter arrow, meaning that the recommendations are starting to shift away from a buy, certainly not all the way to a sell, but they're shifting in that direction. And then the other thing I've put together in that table there is the value metrics. And you can see there's 5 different metrics that I've highlighted, which are part of the value rank. And in 4 of the 5 cases, they've moved in the negative direction. And I've circled all those in red. And then in one case, the price to free cash flow ratio has moved in a positive direction. So you can see that those are clearly the elements that are driving that change in rank, and that gives you a good insight into what is it that is causing this company to shift in its ranking, and depending on your preferences and how you feel about those different things, that will determine the types of decisions you'll make. I should just disclose that I own both Magellan and Codan. Okay, Elio, do you want to move on to the next section now?
Yeah, I think that'll be a good little introduction there. And just quickly to answer you, Jonathan, who asked a question there with regards to cash return on invested capital. Yes, you can screen. Hang on, let me bring myself on screen. You can scan for that within Stockopedia, so that should be available to you. And you can do so by sector. Those sectors are measured by Thomson Reuters, and you can simply highlight which sector it is that you wish to look for, and then basically, therefore, you can change your CROIC. I'm using anagrams again, folks. You can use that in order to adjust and suit whatever industry that you're looking for. So by all means, that there. Sorry, I didn't get a chance to type in my response just as Chris wrapped this up. Okay, so it's now time to get into Stockopedia, and I'll do that right now, and I'll quickly bear with me, folks. Sorry about that. There we are. Should be there. Yeah. Okay. So this is magic on the fly, folks. Hopefully you're all now seeing what we're seeing right here. Okay, so obviously Stockopedia is a very expansive and deep resource with regards to the amount of information that you have available to you. I'm not going to cover all that because that's beyond the scope of today's session, but just a very high navigational overview. Obviously, the Today screen has a range of information, including the article that Chris was referring to, the gravity of change check, the mid-reporting season gravity of change check. So you can read that there if you do have a trial of the system currently, or if you're thinking about it and want to read the full article. The other great thing about Stockopedia is the extensive amount of education that's available for members. Ed invests a hell of a lot of time and effort in regards to producing some wonderful tools. If you can deal with the silver spoon in the mouth and his occasional British humour, which we all take with a grain of salt, of course, he will espouse and share with you how he uses Stockopedia to the maximum degree in order to make investment decisions and be successful and as confident as what he is. The browse section includes a range of different pre-built scans, including top stock ranks that we've been discussing, risk ratings. You can see upgrades, downgrades, also a number of guru screens that you can go through and have a read there. The screen function, Jonathan, whereby we were touching on just a moment before, this is where you can search the entire market for things like, all your QV ranks and all the different sort of blends, as well as all the different factors, plus information in particular. Folios is where you can monitor a whole group of stocks together all at once to gauge their performance. You can also see immediately on the full chart view how they're all going, so you can see which of your stocks are above or below their 50-day moving average, so you can see whether the sentiment is starting to change for those businesses. And we've also got a nifty little bubble chart, which allows you to, whichever blend you wish to apply, be it either quality value, value momentum, or quality momentum, you can actually see how your portfolio sits relative to the approach that you want to do. For those wondering, that little stock that's in the middle of nowhere, that's zip code. And yes, this is a hypothetical portfolio, not a real one. Other features include the discuss. So this is where Chris was alluding to, the market insight section, I should say, in regards to the blogs, where you can read a whole range of articles that both Chris and I write on a regular basis, and glean some education and information from that. And also you get access to the global blogs. So what the global team are actually contributing as well, and you can go in there and have a read of that. And here is, this is the modern day version of having an encyclopedia deck all behind you when you're presenting. Well, nowadays we have this, which is the learn section within Stockopedia, where you can go about and learn, whatever it is that you want to with regards to stocks and getting a thorough understanding. So, Chris, was there any stock that we wanted to start on?
You had a list of a few there that we brought up this morning.
Indeed. Okay, well, let's start with the good one. So one of the good reports this morning was Endeavour Group. So bear with me as I get this just working. What's the busy? It's just gone a little awry. There we are. So we've got Endeavour Group. As they say, during times of recession, look for booze and gambling. Well, the good news is they're doing quite well on the back of that. Now, again, this is not going to be a thorough deep dive in regards to Endeavour, because we want to cover quite a few stocks, and we also want to answer those from the audience as well. But if you don't mind, if you can just humour me for the moment, I'm just going to do quick navigation in regards to those key areas I was talking about. So here I was talking about the stock ranks, as it were. So you can see them immediately. You can see that it's good quality. It's an 84 above 80. So that means it's in the top 20% of the entire market from a quality perspective. Value, just a little lower at 53. Momentum, very strong in regards to analyst revisions and the like, of being 97. Total stock rank is 89. So you can also see right here that it's a consumer defensive. It's also a larger cap business. You can also see it's a super stock as it ranks quite highly across the board. You can then immediately scroll down the screen. You can see the price. You can see the momentum. You can see the various growth and value indicators, the quality indicators. You've got the Altman Z score for those that are assessing bankruptcy risk, which, look, is at the moment just a tad bit in that cautious zone, but we're not in the stress, so that's good. We've also got to the F score, which is the Piotrowski score, F score. So you can see it's a 7 out of 9, which is a good quality metrics. You can see earnings momentum, manipulation risk is low. You can see a financial summary right there. For those that have been quick on the mark, you will notice that there's a TTM. That means trailing 12 months. So because we've had an interim period in the latest period, we've actually incorporated that result within the latest financials, so you can easily assess across the board. And as you can see, as I move my mouse, I can see the trend in all those indicators. And Endeavour hasn't been listed all that long, but you can see that it has been a steady rising trend in regards to the bar chart on the very right-hand side. You can see the profitability measures. You can also see those cash flow measures. Always want to see both profitability and cash flow measures improving. That always does help. The dividend as well is included right there. And then you've got a further assessment of the balance sheet plus a whole range of other information, including this little nifty thing here, whereby you can see the analyst forecast or target price across consensus, and you can see that leading up it had gone up, but then it started to ease a little bit. But guess what? Following the latest report, you can see analysts have upgraded their 2023 forecast from 30.3 cents to 31.3, and you can see they've done a similar upgrade with regards to their 2024 figures, which is another year ahead of where we are right now. And then there's other little bits and pieces of information, but it's one of the reasons why the stock has done so well, because it did beat those analyst expectations and therefore did see a re-rate in regards to the broader business. And a defensive business like Endeavour during such uncertain times could be a good stock to consider and have a bit of a look at. Chris touched on IAG as one of those stocks that have had a tough time. And look, I mean, poor buggers, really. I mean, it's really impossible actually to run a business at this time of year when you've got things like rain coming through on a regular basis. You've also got things like catastrophic claim after catastrophic claim, and then you've got cost of living pressures that are starting to see people reconsider as to whether they actually do need the insurance or not. But with regards to IAG, how did their latest set of numbers come up? Well, if I go straight to the stock rank score, you'll see it's a 61. So it's not necessarily shoot the lights out anyway. You can see, though, that it's decreased by 20 over the last 30 days. One of the other little tricks here, you can actually track how the stock rank has done, and you'll see that it was high, but it's now fallen below. The price has held up quite well during that period. So if you're holding IAG, at least you'll notice that from a quality perspective, it's decreased a little bit, but from a momentum perspective, it's decreased a little bit lot. And you can see as a combined stock ranking now, that's down 20 on where it was previously. The stock is now neutral because of the fact that it's in a bit of no man's land, as you would expect in regards to that. But this is one of those results. If I scroll down here, they were still able to grow revenue, which was pleasing because they're able to increase the prices of their premiums, and profitability also increased. But if I scroll down just a little bit further, you can see that analysts really took the sword to forecast, which is why momentum has been downgraded so much. And unfortunately, on the result of that, it's now a stock that used to be above 80, but it's now entrenched below 80. And as Chris showed us before, there was the faint line 3 months ago. The stock was rated a buy. Analysts have now, the 12 analysts that cover the stock, have now downgraded it back to a hold. Now, this will be in contrast to, say, someone like QBE. Whereas we can, if I call up QBE right here, within QBE, is a little bit of a different picture. They actually do have some green. Their overall stock rank is 92. They've been above 80 the whole way through, including through the recent period. And the good news is that when they delivered their latest financial results, the market really liked them. So the stock had a bit of a spike up. The biggest change to recent times has been on account of value. So the stock now represents a little bit of more value. Not much, though. It's still quite low, or not quite low. Sorry, what I'm talking about. As a 70, it's still not creme de la creme. It's in the top 30% of value stocks out there. So it's not cheap, but it's not overly expensive. And the good news is that that's improved. And you can see we color code everything. So when we're assessing growth and value metrics, you can quickly see against the industry and against the market that on a 12-month rolling basis, things like PE, PEG, earnings per share growth, and dividend yield actually look quite good. If I scroll down a little bit more to go to valuation, well, we've got some fair value in regards to price to book, price to tangible book, but then price to free cash flow and price to sales are actually above the market average. EV to EBITDA in line. So if I scroll down again to the analyst revision during this period, you can see that nice steady trend upwards that's been occurring with QBE for quite some time for both the 2024 and 2023 metrics. And it was good to see them deliver on their latest report. So even though insurance has had a tough time, you can still pick the eyes out of the better ones. And in this instance here, I think it's fair to say the QBE was definitely the best of that lot. Chris, would you like to have a go at one?
What I was going to suggest, Elio, is why don't you just go back to the next few slides. And folks, while Elio's doing that, if you'd like to type in any questions that you have into the chat, and in particular, if there's any particular stocks you'd like us to look at, type those in now, and then we'll get straight into the Q&A in the last 10, 15 minutes.
Right, okay, no problem. So hopefully you've got it back on screen. Oh, no, you won't have it back on screen now because I haven't actually put that up there. With me a moment. There we go. This will take us back. And yes, we'll have more stocks that we'll be covering in a moment, folks, but we do just want to make sure that we touch on this because, of course, it is lunchtime. Some of you may have to go to other appointments, and we do just want to ensure that you're fully informed with regards to what Stockopedia is and how we help investors every single day. So we are a group of over 15,000 subscribers across the board here in Australia, where we have our dedicated service, plus also overseas. UK, our home base, is where the largest amount of our subscribers lie, but we also have UK, Asian members, Indian, also from the subcontinent, who are also members of ours. And it's important to note that as a member of Stockopedia, you actually have the option, if you wish, to purchase those databases too. So if you wish to purchase access to the UK database or the US database, you can simply do that and incorporate that as part of your overall package. All those stock ranks that we've been showing you, those deep insights into what's driving a business at the moment, is available for all ASX listed companies, from Aardvark to Zebra, from BHP down to Mum and Dad's fish and chip shop, if that's a listed entity. So we do it without fear or further. Reporting season is the crucial time because we get our data from our data suppliers, previously known as Thomson Reuters, but now they're known as Refinitiv. We get that data service. Often we turn around reports within 24 to 48 hours, so you can immediately get an insight in regards to where your stock sits, according to all those key factors that drive market performance, where they sit, and therefore you can assess them based on that. It's speed. That's what you get back. This is not a tip sheet. Okay, so you're getting tips all the time. What value do we add by just giving you the same thing that everyone else gives you? What this is a diagnostic tool where you can really see immediately the heartbeat. I mean, you might look good on the surface, but when you get the X-ray in, it's all a dog's breakfast inside. Well, in this instance, it's the same principle. We empower DIY investors to make informed decisions, understanding the true position of their business and what's driving the market or stock's performance at that time. You get access to all those advanced screens and tools that we were talking about there. There's a stack of education on those within the program, but we'll also incorporate them in other webinars that we do for clients from time to time. You get that curated content from the Australian team, so you do get specific stuff relatable to you and your investing style. And I touched on the global databases as well. So there is a free 14-day trial that you can subscribe to today. You can go to stockopedia.com and just join today and get started on a free trial, to which, of course, if you don't like it, you can just cancel and move away. This will give you full access to Stockopedia, everything that we have to offer, from all the company research. And really, at this time of year, is there a better time to have Stockopedia by your side? I don't think so. So why not avail yourself of considering a potential investment in Stockopedia to see how it can empower your investment making processes. There is also a money back guarantee period of 30 days. So even if after the 14 days, you then decide later on, 15 days in, for example, or even 20 days in, you say, oh, look, I don't think Stockopedia is for me, then we will happily refund your money. But to be quite frank and honest, at $475 for an annual subscription, it's really a bargain. And I come from a world where that was a much higher price for most people. So this is really a great bargain. I remember speaking to Ed, telling him that's a little too cheap, but I think he was a bit reluctant to necessarily increase the price because he's obviously considering his global market where it's far more competitive than here in Australia. But you do save 28%. So that 475 is actually a 28% saving if you choose a monthly plan. So you might decide, no, I'm happy to go on a monthly plan, which you can do in order to month by month make a decision as to whether you wish to stay with Stockopedia. But if you take an annual membership, you save 28%. Now, one important thing for me to stress here is that we do ask for credit card details at the start of your 14-day free trial. The reason why we do that is that there's a number of sinister influencers out there. Of course, you've got to remember, we're talking about Stockopedia coming from the UK, and they're not that far from a neighbour of theirs, a little over to the east, who's been prone to get involved in websites with a little bit of scurrilous intent. So we do ask for credit card details just to ensure that you are a real person, that you are committed with regards to the trial. Like I said, if you cancel your trial within the 14 days, there will be no charge. Even after the 14 days, there is the 30-day back guarantee. But I mean, we've just talked price. What I haven't talked is the value. And the value that one gets from having Stockopedia by your side, particularly at this time of year and throughout the entire year when there's all these weird company announcements and what does it mean for its price, how does it change the perception, all those sorts of things. Those insights are exactly what Stockopedia is for, and it's the value that we give all our members every single day. So if you take up the trial and see for yourself, because there's no better way to actually learn the power of Stockopedia than giving it a go and seeing how your stocks do this reporting season. Okay, so we're going to go into, we'll go for it, Chris. It's time for us now to go into some more stocks and also discussion. And we might even extend over the hour for this bit if there are a significant number of them. Apologies in advance if you're unable to stay for the remainder of that, but we will be sending a recording to everyone, of course, and you'll be able to capture those questions in real time. Okay, so over to you, Chris.
Well, there's a question come through from James on JLG, John's Ling. So if you want to pull that up on the screen, Elio, and have a look. They reported yesterday, and it was a very positive report. The report is now being reflected in Stockopedia. Now, one thing that's just important to recognise when you're looking at Stockopedia, during reporting season, is that things can change. Some things change immediately once we get the data updated from Refinitiv, and then other things sort of dribble through. And those are the things that rely on analyst estimates. So as you can imagine, analysts go through the reports, they listen to the earnings calls, and then they write their own views on how the stock has gone and what they think the prospects are, and they send through their forecasts. Now, that sometimes happens really quickly, and sometimes it can take a number of days for the analysts to get around to it, particularly when they're swamped at this end of reporting season. So some things will update gradually. So it's worth keeping an eye on the page, the stock that you're interested in each day. But there's already, you can see some updates that have come through for John Lin. Is there anything you want to add to that, Elio?
Oh, no, just to state what the power of what it is that it actually provides. I mean, you can immediately see the company is rated as being high quality. You can see that the value has been a little bit challenged, and we're going to start to see some of that momentum, as you mentioned, Chris, flow through with regards to those earnings. So as far as I'm concerned, this will look pretty solid. You can see the market obviously liked the announcement on the back of that. So its quality factors have come into play again. The price that had been moving down, one would argue that just would have been investors taking some profits off the table, given that from a value metrics, the stock was, a little bit highly priced. But the bounce that's come in its share price on the back of its latest numbers has contributed to the improved quality. Whether that's sustainable or whether investors still say, no, it's a little bit expensive, well, a lot of that will be driven through the momentum factor and what those analysts do, as you mentioned, Chris. So that'll be, definitely something to see. And, really look forward to assessing, because it is one of those businesses that has quite some time exhibited those quality factors, but it's just got too highly priced, and hence why the price has been a little bit stagnant in recent times. Is there another one, Chris?
I just wanted to make a couple of points while you're on that screen, Elio. Can you click on the print button just to the right of add to portfolio?
Yes,
that one there.
can.
So what you can do with this here is you can see these dates appearing. And for example, if we picked, say, February 12, you can, February 12 up. Yep. You can see what this screen looked like a week or so back. And what that enables you to do is to directly compare how does it look today.
Unfortunately, I'm not logged in at the moment, so apologies for that, Chris. So, but yes, that's what you could have done.
You understand the concept. That's where you can do that. The other thing I wanted to show people, if you click on accounts and go to down the bottom there, you've got major shareholders. And this page enables you to see, who are the key individuals or institutions on the register, and how much of the business is tied up, or how many of the shares on issue are tied up with strategic shareholders. In other words, that gives you a good idea of the liquidity of the business.
Yeah,
that was a question that somebody asked: is can you access that information? And yes, you can, and that's where it is. So we've had another question come in. It's not specifically stock related, but it's asking about how can we screen for stocks. So I don't know if you want to just very quickly go through the screener, Elio, and how that works.
Okay, so where I've gone, folks, in case you're wondering, is I've clicked on screens, or just moved my mouse over to the left, there's screens, and I've selected new screen, which has brought up this page right here. Obviously, at the moment, it's looking at 2,000 or 1,945 companies, to be specific, currently all ranked by stock rank, as you can see. So Coronado being right up the top there, the metallurgical coal company, having had a very good stellar run and having had the strong rating for quite some time, and a number of Stockopedia members benefiting from that. But in order to access the screen or to utilize the full power of it, all I need to simply do is click on Add Rule. And within Add Rule, you can see there's a range of different criteria that one is able to search for, a whole range of them, based over the various factors. You have dividends, analyst expectations, miscellaneous, account statements, etc., etc. If you know what you're looking for, you can actually just quickly type in the term. So say I'm looking for dividend yield. I can start typing in the word in the search, and you'll see anything where the word dividend appears. So I've got dividend yield, dividend cover, dividend per share at the constant average growth rate. So that's an average number over history, folks. But if I just select dividend yield for the moment, I can look for dividend yield over different time periods. I can do it rolling. I can do it the trailing 12 months, which is the calculation method we use to encapsulate the latest 6 months in the previous period. We can do rolling over a year, 2 years. We can do the 5-year average. We can do a different derivation of the 5-year average. This is an incredibly powerful scanner that allows us to do a whole bunch of stuff. But you can see here that immediately it's brought up dividend yield, TTM, greater than, and all I need to do is just type in a value. Let's just type in 5, and the system's iterative. So you can see immediately I've weeded down the 1,945 companies down to 216 results. So all these companies pay dividend yield over 5%. Now, of course, that's probably still too big, so I can add more criteria. So, for example, if I wanted to add EPS as a criteria, I could also go into things like, for example, let's go look at full F1 year. So this is the coming forecast year, so the current one. Earnings per share estimate upgrade. I'll select that. So I'll click on Add Rule. And again, I'll do greater than 0. So let's just look for companies that have had positive upgrades over the period. So if I type in 0 right there, you'll notice, there we go. Literally in a matter of seconds, folks, I've whittled down 1,945 companies down to 21 companies that are paying above 5% and also have a forecast earnings upgrade over the past month. And that list appears right here. Of course, you still need to do your research. You still need to go in and actually do a sanity check to see that the business is doing okay, that it's not just some foible in the architecture, that is seeing the analyst upgrade occur. And then, yes, if you like the business that aligns to your investment strategy and your tolerance to risk, and it has the QVM score or whatever factor score you want to rely on in order to make a decision, then you can buy that stock with confidence, knowing that the numbers are above board, that it has the qualities you're looking for, and you've also done a little bit of research to make sure that everything is okay with these businesses. So the screener, Chris, is far more effective when we're trying to find new opportunities, as opposed to the previous examples where we've sort of had them given to us, like, which can be a very common tip, like you receive in the newspaper, on the countless websites that are out there, even from us when we write our particular articles in Stockopedia. So the screen is a great tool to just go in there, grab some criteria, bring some stocks onto your platter that might seem interesting, and then you can just be cold and calculated, folks. Just go through, run through the list, see the type of stock you'd want to hold, and then consider it for inclusion if that's the way you want to roll. Okay, Chris, what else do we have?
Well, we have gone past the hour, and I think we've covered off the bulk of the questions in the Q&A. So unless there's anything pressing,
look, I'll just, yeah, I think we will. I just want to show one more company because, of course, just to re-emphasize the power of the research and how quick it is to go through this process. I mean, in the space of 1 hour, you have to sit there and listen to me talk for 20 minutes in regards to our methodology, and then a little bit about reporting season. So literally over the space of 15 minutes, we've covered something like 6 or 7 companies. And a lot of that was explaining too. So it just shows you how quickly you can go through this process. But another company that reported this reporting season, who I was particularly happy with, was Wesfarmers. So, yes, I'll leave the scanner for now. And Magnolia, that's a yes to your question, by the way. I was about to type a response, but I couldn't get to it in time, but that's a yes to your question. So Wesfarmers, we all know them, massive conglomerate, as it were. You can immediately see that over the last 30 days, its quality rank has improved. And because of that, so has its overall stock rank, which is lifted by 8 as well. The momentum one still looks quite solid. Fair value, yes, it's not the cheapest stock. It's not the most expensive, though. So if you're looking for a stock that's high quality, high momentum at a fair price, then that's what this stock rank is showing us. Then that may very well apply to a Wesfarmers. You can immediately see that it is a high flyer because it ranks highly on quality and momentum, but the value is relatively muted. So you can see it's in consumer cyclicals. You can see it's more for the conservative in regards to its volatility measures that we apply to the stock. It's obviously a large cap business. You can quickly and easily see here there's a little bit of mixture with regard to its growth and value. And we've already discussed that up here because that's all encapsulated in this top score. But you can see momentum. There's all green dots everywhere. You can see with regards to quality, good return on capital, good return on equity, health trends solid, bankruptcy risk is low, it's safe, quite easy there. You can immediately see the cash flow figures. You can see the profitability figures. You can see the dividends per share. You can track and see how they've done historically and therefore measure where they are at the moment. Analysts haven't changed their view in regards to buy, hold, sell just yet, but you will notice they did upgrade their forecast with regards to earnings expectations over the coming period. A question I often got asked over the many years. So yes, Wesfarmers is one of those stocks that suits most type of investors. So I think one of the questions that I've often received over the years when it comes to forecasts is clients often ask how much weight can you put on forecasts? How accurate are they? Now, of course, they're the best guesstimate of all the wonderful, learned young men and women that are analysts sitting in ivory towers and compiling the numbers that are then espoused and shared with the masses that we then digest and try to make sense of. So how relevant are they? Yes, obviously, there's a bit of guesswork in them, so they're not 100% accurate. We know that. But what I tend to find is once a company has reported its half-year results, that the forecasts start to get a lot more accurate. Because in essence, the analysts can only get 6 months wrong. We've just had 6 months of actual returns. So this is now a great time to be using Stockopedia from now through to next reporting season, which will come around before you can blink in August. So now's a great time to Stockopedia from now till then, as we start to see the changes in forecasts. Because now that we've had 6 months of actual numbers, an analyst can only get 6 months wrong, which means they start to come closer to the mark. And as we get closer to the company's report, those numbers will get more accurate and they'll come in together. So, yes, I think you can actually put a bit of credence in regards to analyst forecasts, particularly now that we've had 6 months of actual results put through. And now analysts have been able to just tinker their adjustments relative to the next 6 months. And they can only get those 6 months wrong. And they'd have to get them really, really wrong if they were to mess that up. So as time goes on, they'll get even more accurate, which makes it much easier to when it comes to assessing a forecast. But just before we say our formal goodbyes and our thank you, just to reiterate, please take the 14-day free trial, jump on stockopedia.com and see for yourself the power of this tool. It's an absolutely amazing tool. The insights it delivers in the fraction of a second needed relative to you actually having to do it yourself is an investment like no other. Very reasonably priced, potentially tax deductible depending on your own personal circumstances. So please speak to your own account there in regards to that. And yeah, just to reiterate, it does ask for your credit card details, but that's to protect our business from more sinister forces that can possibly look to take advantage of us or advantage of any system that offers a free trial. The trial is limited to only one per year. It's just important for me to remember that. And yes, at the end of your trial period, if you haven't cancelled, you will be charged. But as I said, Magnolia, there is the 30-day money-back guarantee after that period where you can actually have that amount refunded to you. But I'm fairly confident that if you're committed to staying the 14 days and you're going to be on that you'll find exceptional value with Stockopedia and having us as a partner of yours in your investment journey. To which I have to personally thank you all for being on our journey this afternoon. It's been wonderful to speak to so many of you, to espouse the virtues of the wonderful business that we represent. And I sincerely look forward to talking to you all again in the not too distant future. Chris, over to you.
Yes, thank you, Elio. That really sums it up. If you do have any questions that we've been unable to get to today, please feel free to send them to us. There's a chat function on our website or in the app, or you can send an email to support@stockopedia.com.au and we'll get back to you as quickly as we can. So thanks again for tuning in, and we really appreciate you taking the time to listen to our presentation.
Thank you. Bye now, everyone.
All right.